everyone. Welcome back to another episode of Getting a Cashflow Game with K&K. Got it right that time. Anyway, so today we're going to jump right into it. Crystal, it's just Crystal and I today. We're going through the process from start to finish of how to invest in real estate, and we're going to kind of like break it piece by piece.
And more specifically, multifamily.
Yeah, and so you'll be listening to a lot of us, but at the end of this, you're going to get a lot of nuggets. But today, we're going to talk about the different ways that you can invest in real estate. And also, before that, Crystal is going to be so kind enough to talk about, first of all, what in the world is a personal financial statement? Because for a lot of people, you mention that just because we know it, they'll go, what is that? So she's going to tell you what it is. She's also going to tell you why you need it. And also, she's going to tell you what you should include on there, and then what doesn't go on there possibly, and then why it's so important to fill that out, know where you stand, because that might determine how you invest in real estate. Did I get that correct, Crystal?
Yes, that was a very good description.
Ooh, yeah.
Kudos.
Cool. So tell us, what is a personal financial statement and why is it so important?
So the reason why I'm talking about putting together a personal financial statement today is it sort of goes hand in hand with determining what sort of investor you want to be or how you want to invest in real estate, because your financial capability is really sort of going to let you know what your options are. So your personal financial statement, if you're used to coming from the real estate world, you fill out a 1003. And a 1003 is somewhat similar to a personal financial statement, but...
Hold on one second there.
Oh,
remember. Sorry, guys. A 1003, aka a loan application. So I just want to make sure some people, we know that, but they don't know that. So it's a loan application, to not confuse you. If you don't know what a loan application is, that's what you filled out to get a 1 to 4 unit mortgage, most likely. Sorry, continue.
Thank you. Yeah, so that's what a 1003 is. It's different, but it has a lot of the same information. So a personal financial statement, generally, like at the top, you're just going to fill out your personal information. Name, address, probably your social security number.
Birth.
Usually your employment is on there as well, like where you work, how long you've worked there. Then it's also going to go into your assets and liabilities to determine your net worth. So on your assets, on the left side is usually assets, and that's where you list what, the amount of cash that you have in the bank, cash equivalents, so stocks, bonds, marketable securities.
401k, all that stuff.
You can put your 401k or, the value of your life insurance on there, but unless you're close to being able to access those funds, a lender's really not going to count that as liquidity. So you can put all that stuff on there, but they're really looking at cash or cash equivalents for the purposes of qualifying. It may help you in your overall net worth, though, so you probably do want to include that. Of course, you're going to put other assets on there, so you can put, cars and boats and whatever else, other valuable things that you might have. So that's what you put on the left side of, on the asset side. You might also put the value of your real estate on that side as well. So on the liability side, you're going to include basically all of your expenses. But when I say expenses, the actual amount of the mortgages you have, not the mortgage payments. You're going to put your actual mortgage balance on there. You're also going to put any sort of other loans like revolving debt, credit cards, any other kind of debt. But the liabilities are really like the balances of that debt, not the payments on that debt. So that is how a lender is going to come up with your net worth. It's your assets basically minus your liabilities. So that's basically what lenders are looking at. So if you're wanting to invest in apartments, why is that important? That's important because lenders generally aren't going to give you a loan for that is anything more than your net worth. So the loan amount should be equal to or less than your net worth. So if you have a net worth of $1 million, a lender is really going to only feel comfortable to give you a loan on an apartment building or any other type of real estate for $1 million. So that is why that's important. And that's why the financial statement is so important. But additionally, on the financial statement, there will be a section for your income. So you are going to put, salaries, bonuses, your net rental income if you already own rental properties. Then you're going to, so that's going to be your income side, so a lender can see what kind of income that you're using, and you really want to be accurate with it, sort of based on your tax returns, because once they move forward with you, they're going to be verifying all of this information. And once you become a real estate investor, this is really something that you want to have and maintain regularly. I mean, Kenny and I maintain our personal financial statements because we have to do annual reporting for all of our loans, and they request this information. And then if we're getting new loans, whether we're buying something or we're doing a refinance, we just have it readily available. But if you're making offers on properties, they may want to see it. Certainly for financing, you're going to need it. So you want to start maintaining that financial statement. And then what's usually attached to the financial statement is your schedule of real estate owned. So if you own any real estate, you would normally put that on your schedule of real estate owned. Just, property address, type of property, the estimated value, the amount of mortgages you have against it, and then it's basically any income you get, any operating expenses, the cost of your mortgage, taxes and insurance expenses, and then that gets you your net income or your net expense, really. So that's essentially what a personal financial statement is. And it's nice to know where you stand financially, too. So
let me jump in here. Couple things. You said a lot of information, so I'm just going to back up a little bit just to talk a little about the personal financial statement, because people might be listening and go, okay, in my mind, I'm thinking I may have a couple questions. So question number one is, if you own a business, you're self-employed, and let's say there's value to that business. Let's say you own I don't know what you own. You own some business, a clothing line or something, right? That could be worth something that somebody could buy from you, right? So if you have a business that's sellable and there's a value in that business, it's worth $1 million, $2 million, $3 million.
Absolutely, you would add that to your assets.
So question on that, if I have a business and I think it's worth $2 million, okay? Mm-hmm. Is the bank going to require an appraisal, or how do they verify that? Just curiosity.
They will not require anything like that, but they will usually on your tax return. There will be some sort of an indication of how your CPA is valuing your business. So you can't really put a crazy valuation on there and have them use it, because they will dive into stuff a little deeper, look at your tax returns, look at the basis that your CPA is using for your business, and they will more than likely use that number or something very close to it. So you can't, if your CPA is saying that your business is worth $1 million, that the basis is $1 million, and then you're saying your business is worth $5 million, they're probably going to cut that out. So, and even the same thing with the values of your real estate. So if you are valuing your real estate, they're going to look at that and make sure that those numbers are reasonable in underwriting. So I don't see it happen very often where they're cutting values, but it does happen once in a while. And, most of us have an idea of what we think our real estate is worth. And, as long as it's ballpark in there, they're not like appraising every single one of your properties or doing some crazy in-depth research. But hey, look, if a lender's looking at doing a loan for you, they more than likely finance a lot of properties in the community, in the area, and they sort of have an idea of what values are worth. If you own properties out of state, they're probably going to sort of run a quick search to see what other properties in the area are selling for, whether they're looking on LoopNet or CoStar, and they're going to derive, whether or not those values look reasonable.
So if you own classic cars, art, crazy jewelry, things like that, there is value, paid off. Is that something you include on your personal financial statement?
You can, but if it's excessive, they're not going to give it a lot of weight.
Okay, cool. And with regards to the debt side of it, if you got student loan, business debt, anything like that, does that need to be included 100%. On the business debt too?
Yeah, any sort of debt should be included on your liabilities.
Okay, cool.
So on the liability side, so if you've got student loans, that would be included, the balance of your student loans. If you have any other sort of debt, even if you got a private loan from a family member or something, you would put that on there. If you have a line of credit or a HELOC, you would put that on there. So all of your actual debts go on the liability side. Okay,
cool. And then just so everybody is realizing that when Crystal's talking about this personal financial and buying property, we are talking about commercial property. This is not...
Or multifamily.
Yeah, this is not a 4-unit.
5+ units.
Yeah, this is
or
not...
commercial.
1 to 4 unit is looked at completely different.
Yeah.
They don't require a net worth and stuff like this. Obviously, you have to qualify, with the reserves or your job or whatever. So this is strictly like this is a lender taking like a 30,000 foot view of you, not getting too detailed and saying, okay, Crystal and Kenny, what do you guys got going on? And grade all this stuff. At the end of the day, are you negative, positive? What's the number? That's one place we look at how we're going to lend. This is a trigger. So let's start. Let's just say we've filled out the personal financial statement. And guys, if you have questions about this or don't know, obviously you can always reach out.
And also, if you want a form, I can send you our form. It's in a fillable PDF. And then we have a real estate schedule that's in an Excel format. It's a format that most of our lenders use. It's super easy. It's nice to have one so that you can maintain it. So I think it's a really good idea to just do this exercise, because this is the other thing. You're not going to get pre-qualified like you're used to on the residential side. Like on the residential side, if you've ever bought a house, you know that you're going and getting pre-approved, hopefully prior to even submitting an offer. But a lender's going to look at all of your documents. They're going to look at tax returns and bank statements and other mortgage statements, and they're going to look at all this information in addition to your loan application and determine whether or not you qualify and give you a pre-approval letter. Well, if you come to a lender or anybody, a bank, me, and say, can I get a pre-approval letter? That's basically telling me that you're a newbie and you don't know that we don't do pre-approval letters for multifamily or commercial. And that's okay, but what I do want to explain is that you can very easily sort of pre-qualify yourself on the basics. You definitely want to talk to a mortgage broker about what your plans are and figure out what type of financing options there are, what other requirements there might be. But you can fill out your personal financial statement and sort of just check the boxes. Okay, at the end of my down payment, how much cash do I have left in the bank? A lender generally wants at least 10% of the loan amount in post-close liquidity, so cash in the bank or cash equivalents after you close escrow, and they will not give you a loan that's greater than your net worth. So these are the couple of things where you can look at it and go, okay, what's my net worth? Okay, so this is about the amount of the property I can buy. How much cash do I have in the bank? Okay, well, I can't put down more than X if I want to get a loan. Like if I need a loan of $1 million, then I need to have $100,000 in the bank or in stocks or bonds or something that I can access after I close in order to qualify. Or if you're close, we can have that conversation. Things are not 100% set in stone, but these are pretty basic guidelines. So you can honestly pre-qualify yourself. And that's why this is such a good exercise.
Yeah, and honestly, like Crystal just mentioned the word exercise, it's even if you're not going to, it's even if you're just listening to this and you've never done this, you should sit down with your husband or whatever yourself and fill one of these out, because it's good to know. And the one thing is that a lot of people don't focus on, and I believe the rich and wealthy do, is they're always boosting their net worth. And a lot of people don't understand why the net worth is so important. It's because they're investing and doing different things, because they can't do this investment or do that because they realize you have to have a certain net worth. So a lot of them, the way they make moves and stuff is they're trying to build up their net worth because they might have, lofty goals. They want to hit something. Like Chris said, if you don't have that, you can't do certain things. So you're handicapped.
Well, and if you don't know where you're at, you don't know where you're going either. So you really have to know where you stand financially. And not everybody feels comfortable with this. Not everybody likes doing this. But it's something that you need to do. You need to know where you stand financially. You're going to find out eventually anyways if you move forward with a loan. But you really want to be prepared. Like, this is part of being prepared for buying anything. Whether you doesn't matter what you end up deciding you're going to buy. This is part of the step to discover what kind of investor you are, what type of property you can buy, and what your options are, and then you now know where you stand.
Yeah. So let's jump into it. I'm going to talk about the first, then if you're jumping into real estate, the first opportunity that could be is just direct, basically just buying a place yourself, right? So you fill out you basically at this point, you've probably filled out a personal financial statement, you probably met with somebody like Crystal, maybe you've talked to a commercial broker that sells real estate, and you realize, cool, I've got this net worth, I got this much cash in the bank, and I want to go buy a 10-unit building, and I want to do it myself because I can do that. So the first, obviously, is you're just doing it yourself. There's no partners, there's no nothing, it's husband, wife, or whatever. That's it. That's just a straightforward deal.
So that's pretty much,
simple.
that's like one of 4 ways that you can invest. We're not talking about what kind of properties you can invest in. We're talking about the ways that you can invest. And there are really 4 ways that we know of to invest in real estate.
Yeah.
And the first one is as a direct owner, just buying property by yourself or with your spouse or whoever.
And so the next one, Crystal, is with a partner. So can you talk about, when we talk about a partner, how that is different than maybe a syndication? Because some people think, oh, it's a partnership. They think that's a syndication. They not realize that's not really what it is.
Well, there's a very big difference between a partnership and a syndication. So a partnership is just, like, let's say, for example, and this is why I say the personal financial statement is important. Let's say you look at your financial statement, you really want to buy apartments, but you don't have the net worth. Maybe you've never owned a property before or something like that. So what you can do is go out and get a partner. Of course, you want to make sure all the things that you guys are on the same page, you have the same ideas, you have the same philosophy in investing. There's a lot of things that you got to agree with a partner. But you could say, hey, how about we go 50-50 on this deal, or 25-75, any sort of percentage that you want. But this person's also going to help you bring strength to the deal because you're both going to go on the loan together. If you own, the general rule in financing for us is that if you own, any owners that own more than 20% of the property have to go on the loan. So if that's the case, then you would have a partner that would also bring their own liquidity and net worth into the deal to help you
and their
qualify.
personal financial statement.
Yeah, and if you don't have experience, but this partner already owns properties, then they can help bring that experience to the table as well. And if it's your first time buying, we can still get you financing. There's going to be a few more requirements, but it definitely makes it easier to qualify if you've never owned real estate or if you're new to this, to maybe bring in a partner who has some experience but can also add to the net worth and liquidity requirements so you can buy a bigger property.
Yeah, and also too, like Crystal said, a lot of people are getting partners because, look, they might be the money person, so you might be the sweat equity guy. You're like, I found a deal, I've got minimum money, but I'm gonna manage a property. I'm gonna do the whole thing, which is work. But you've got a doctor over here that makes a couple million bucks a year. He's got a ton of money, big net worth. He doesn't have time for this, but he's like, cool, I'll give you most of the money, and we're 50-50 because you're the sweat equity and he's the money. But you're utilizing him. You need him and he needs you, right, to make a deal work.
Yeah, so or you just partner with a friend. There's a lot of different ways that also has money, and then you guys can determine what the responsibilities are between the two of you. But basically what a partnership is just that. Like, you get equal money in, like your money in determines your percentage unless you have a different arrangement with someone. That's something that you can do. And I've certainly seen it done where somebody says, hey, we're going to go 50-50, but I found the deal and everything, so I'm going to get 50% ownership, but I'm only going to put in 30% of the money. For example, like, you can do things like that. People have done them over the years for sure. There are very busy professionals who happen to have cash that they need to put to work, so that's also something you can do if you have someone like that in your life. But the other thing is just investing with friends or family or people that you know, where you just get a direct percentage based on the actual amount of money that you're putting into the deal. It's very different from a syndication because a syndication goes through the SEC. There are rules. There are disclosures that you have to make. There are very strict rules that you need to follow to avoid getting in trouble. So definitely I would be careful about using that word syndication unless that's truly what you're doing and you have an attorney helping you do it and drafting all of your documents. But it's very, very different from a partnership. Yeah,
speaking of syndication, do you want to just jump into that as on next on the list, because that is on our list?
It is.
So when people hear that, what exactly is syndication?
So the great thing about a syndication, if you're a syndicator, you're doing all the work. So you're building the relationships with brokers, you're doing all the market research, you're finding the deals, you're making offers, you're doing all of the due diligence, you're negotiating the contract. And then
you're walking the property.
Generally, you're also the guarantor on the loan. So you're getting all the financials. You're putting your financials up. You're guaranteeing on the loan, or it may be a recourse loan or a non-recourse loan. It's a whole nother topic. But that's what a syndicator does. And then once you close, the syndicator basically manages the asset. So even though you might have a property manager in place, which we always recommend, they are making sure the property manager is doing what they need to do. They're, forecasting and budgeting and overseeing any capital improvements that need to be done. They're figuring out other ways to increase the income. They're answering all of your questions as an investor to all of their investors. They're reviewing monthly financials. They're doing a lot of things. Like basically the syndicator is doing all the work and they're also getting compensated for it because so like I said, if you're a syndicator, you generally are very transparent about what you're getting paid, but usual structure for a syndicator is to charge an asset management fee. So it would be very similar to like a property manager. So let's say you hire a property manager and you pay them, 5%, a 5% property management fee. And then if you invested with a syndicator, they're probably going to get a 1.5% to 2% asset management fee on top of that. So that would be based on the net income for every month. So they get paid that fee every single month, and it's based on net income. And it's really not a huge fee. Like, let's say for simplicity, let's say you invested in a property that has $10,000 of net income every month. And they're charging you a 2% asset management fee.
$200.
$200. Yeah, so it's really not much, but it helps them to kind of keep going and managing the asset. But they generally also will put I would probably only invest with syndicators that put their own money in, but most of the time they put a little bit of their own money in. They get a direct percentage for that, but they, on top of it, will get the asset management fee. They generally also get another override after you're paid on the monthly income as well as usually the sale, and that generally ranges from anywhere from like 10 to 20-ish%. I've seen higher, and they do have different, more complex structures, but essentially you're paying someone to do everything for you, and that's what a syndicator does, all of that work. So that is.
And they might charge a percentage when they purchase the property one time.
Yeah, some charge. I've seen them charging acquisition fees at the sale, fees for securing financing. I've seen a lot of different structures. They do make some different fees. Generally, if they're doing a fee on the sale, it will generally be benchmarked by selling at a certain cap rate or a certain price or something like that. It might be tiered down. They don't get that extra fee if they don't hit the mark. So there are different structures. It is a lot of work to be a syndicator, to do all of that, because you're essentially bypassing, like, as a syndicator, you're doing all the heavy lifting, and then you're just taking people's money as investors and giving them a return every month. But they invest passively, which is the fourth way that you can invest directly in real estate.
Yeah, so just on syndication, I would say that, I think you basically think about it this way: is you're putting your money in with somebody, and they are highly motivated to make you a good return. They're highly motivated to improve the property, and whether it's 3 years, 5 years, 10 years, they're highly motivated to have a good exit, so make you cash flow. And then hopefully if you put $1 million in, maybe in 10 years they give you back $2 million, or you roll it to the next deal, whatever it is. They're very motivated to make you a return on your money, and like Carissa said, it is a lot of work, but it's a specific person that wants to do it, but usually the person that does it really likes to do what they do. And then passive is, and look, by the way, we work with all these clients. Like, these are clients, we know them, so passive is just almost, if you invest in a syndicator, that could be passive too, but passive is another way. Is there could be REITs, there's funds, there's different things like that. So most commonly it could just be a REIT, you throw it in there and you're getting a return. It's almost the same thing, but it's a little bit different than a syndication, because it's technically like a REIT is not a syndication. Yeah,
there's a lot of different groups that you can invest your money in, but essentially being a passive investor is exactly what it sounds like, where you give someone your money, and they may or may not guarantee you a certain return on that money, but you essentially let them do all of the heavy lifting. So I think, the great thing is if you're a busy person, like let's say that you own a business, or your job just requires a lot of time and you don't have that, and you really want to invest though, and you want to start making a return, but you just don't have the time to build all these relationships and do all this market research and make all these offers and negotiate all this stuff, and then when you close, like, manage the property and deal with problems that come up and oversee your property manager. There's a lot of things there. So if you want to keep it simple and you don't have the time for that, and you don't want to divide your time like that, because sometimes your time is best spent focusing on your business, investing in your business, investing in yourself, and not doing all of this extra work. So investing passively is a great way to still invest and still make a great return, but not to have to build all the relationships and do all of the work. So I would say still, if you're going to invest passively, that you need to make sure you're still reviewing the investment. You still, at the very minimums, are going to want to learn the basics of whatever asset you're investing in. In this case, we're always talking about apartments and multifamily because that's what we believe in. That's what we know. So if you want to invest in some apartments with a syndicator or any different sort of group, you really want to review the investment package, and you want to vet the information.
Even a partner too.
Even a partner, but if you're a partner, you're probably looking at all this stuff already. But
hopefully, yeah.
If you're going to passively invest, you definitely want to look at this deal because you're going to own part of it. Yeah. So you want to make sure it's not just the track record of the syndicator and making sure that they're really, on top of it and watching over the asset and doing all the things that they need to be doing. It's also looking at the deal and making sure it's a really good deal or something that you want to invest your money in. Yeah.
So those are kind of, and the cool thing is, if you to wrap up, is direct, partner, passive, syndicating. The cool thing is that obviously depending on, I can't answer all the question financially where you're at and with taxes and all that, but you still, at certain levels, you still get benefits of taxes, and most syndicators are probably going and doing a cost seg, and then they're going to maybe do accelerated
100%.
depreciation, something you can get that. So there is a lot of benefit. I mean, full transparency, we do tax returns for people that are in syndicated deals or passive investors.
You don't do tax returns for people.
I do loans for people.
Yeah.
And when I typically get the tax return, I get a K1. It's negative, and so obviously I have to call them back and say, this is not negative. I know it's a positive. I need the tax return from the entire syndicate. Why? How much did you make last year? Well, they gave me $100,000. Well, this says you lost $50,000. What? So what they report on their tax return says I lost $50,000. What they actually got in their pocket said I made $100,000. So I got to go back to the return, add back depreciation, and I put it back and go, oh, he really made $100,000. So these are very good key vehicles to, obviously, there is a lot of money when you put it in, as you're getting this tax-free money, and so there's a lot of other advantages. Either way, a lot of people are investing in real estate. They want to do it direct, passive or not. You're getting the cash flow, you're getting the tax advantage, and you're still getting the upside appreciation over time.
And I always add the disclaimer too that we are not CPAs, so we're not giving you tax advice. Yeah. This is something you want to check with your CPA on, but there are many, many, many tax benefits to owning real estate and ways that you can offset your income to pay less tax. But you need to go through those rules with your CPA and look at your whole financial picture with them. I mean, this is like one of the things that we learned early on is if you want to become, a real estate investor and you really want to take it seriously, you need to consult your team, which is the last episode that we talked about, is building your real estate team. But this is when you're going to call your CPA and say, hey, I'm considering doing this. Exactly. What sort of benefits are there? Hey, I'm looking at investing in this deal passively. They're saying that there's this tax benefit. Can I, how is that going to benefit me? Am I able to benefit from it? So this is the stuff that you want to talk to your CPA about. We're giving you ideas of things that we've been able to benefit from, we've seen our clients benefit from, but you need to talk to your CPA about your specific situation.
That's it. Thanks for listening, guys, and I look forward to keep going down this journey, and it's endless. There's so much stuff to do, so we enjoy talking about it.
And if you feel like anybody else who wants to invest in real estate, or someone who's interested in learning more, please have them listen to our podcast or subscribe, or leave us a comment below if there's something that we missed out or didn't list. If you do want a copy of the personal financial statement and real estate schedule, you can always reach out to me. You can email us through our website at gettingthecashflowgame.com, and I will be more than happy to send it to you.
Yes, we love 5-star reviews.